Well, our first guest this hour has addressed this issue many times and has plenty of views on the current situation. Nouriel Roubini, who predicted the 2008 crisis, is an economist and the head of Roubini Macro Associates. He is also an accomplished author that includes the recently released Megathreats, and he joins us now with his latest assessment. Mr. Roubini, thanks very much for your time today. We appreciate it.
Great being with you today.
This feels like a moment. How would you characterize what we are living through right now?
Well, it's an extremely dangerous moment because there is now significant stress in some parts of the U.S. banking system, the time when inflation is still too high, and both the Fed and the ECB have to figure out whether they want to fight inflation, in which case they raise rates and they can cause more financial instability, or whether they care about financial instability and they go more slowly, but with high inflation, they may risk to de-anchor inflation and inflation expectation. So in some sense, the central banks now are damn if they do and damn if they don't.
And what do you think is the right course of action? Obviously, no easy decisions to make at this point.
Well, either way, I fear that we're going to end up into a hard landing because inflation is still too high. The Fed should go at least to 6% with the Fed funds rate. The ECB should go at least to 4% with their depo rate. They're still very far away from that, given what's happening to the real economy. But now the strain coming from the fact that there is too much debt in the system, private debt, household debt, corporate debt, bank debt, other financial institution debt, and in some country, high sovereign debt, implies that as you tighten more, those kind of debt strains and tightening of financial conditions are going to get worse. They're going to make that hard landing more severe and more protracted. So I think that whatever they do, they're going to end up in trouble because at this point, it's too late to find a solution that prevents a hard landing and prevents severe financial stresses.
Every moment in the markets is independent in the sense that we're constantly marching through time. We can see moments that seem to rhyme, and obviously we referenced your expectations on what might happen back in 2008. I'd like to ask you why you think we are in this moment right now, considering the so-called lessons that we were supposed to have learned in 2008.
Well, in 2008, it was more about credit risk, too much leveraged households, housing debt, mortgage debt, and bank debt. This time around, for now, we're worried about what's called interest rate or market risk. Those institutions that have long duration bonds, with the rising yields, the price of the bonds has fallen by about 20%. US banks alone have about $620 billion of unrealized losses with a capital base of about 2.2 trillion. So on average, 28% of their capital could be wiped out if these losses are realized. And this is just because long rates have gone higher, the price has fallen, and the value of those bonds and MBS is lower. And some financial institutions in the US, like some of the smaller regional banks, have more like 50% of their capital at risk. And in the system, we have about $20 trillion of fixed income long duration assets that are long-term treasuries, high yield, high grade, EM debt that is linked to the dollar, that is also now has been subject to losses because yields have gone higher and the price, market price of these securities has gone down. So we're speaking about $3 or $4 trillion of losses in the entire system for the US alone. Some of those losses are realized, some of them, those in the banks, they are not realized. So this is a strain on the system. It's going to make the hard landing worse.
Now, you gave a helpful outline there, and certainly as we watched the collapse last week of Silicon Valley Bank, a bank that had placed a high level of capital into longer-dated securities after those deposits had surged. And to your point, as interest rates rose aggressively, that resulted in unrealized losses and then a very complicated moment for Silicon Valley Bank, which we watched unfold. We mentioned already today we're continuing to watch other regional banks like First Republic. Our Bloomberg colleagues are already reporting on a collective effort to bring deposits to that troubled financial player right now. How do you feel about coordinated efforts by the U.S. banking players to try to avoid another collapse of a U.S. financial institution?
Well, some of these financial institutions are going to need definitely more capital. The question is whether JP Morgan and others can corral a variety of institutions to inject that capital. It's not going to be that easy. The other option will be for some of these smaller regional banks to be taken over by some other larger financial institution. But the Fed and the regulators worry already about the excessive concentration in the banking system. So definitely there are some of these smaller players that have massive unrealized losses. They have a very narrow deposit base, in some cases wealthy individuals, or in the case of Silicon Valley Bank, it was wealthy VCs and tech firms. And they have a large fraction of their deposits are uninsured. And even with the backstop of the Fed, if you're a deposit or a wealthy individual in some of these banks, better safe rather than sorry, because you don't know whether they're going to backstop you the next time around, given that now in Congress, both from right and left, there are people saying this is a bailout and people are screaming and shouting against it. So I think that the fundamentals of the drivers of a run on some of the smaller banks are going to stay with us.
Well, I'm glad you worked through all of that, because you've outlined really these two areas, watching what central banks do as they grapple with the inflation realities and the worries or the stresses within the financial markets. But then I mentioned this is the 15th anniversary of Bear Stearns being acquired by JP Morgan, a deal that came together because the government had urged a deal to happen. And clearly it seems like in this moment, there is an urging on the part of Washington to see at least the industry work together to avoid further collapses from what we've seen. It reminds us of words like moral hazard. And I will remind our audience that it was 6 months after Bear Stearns was essentially rescued that Lehman Brothers collapsed. How much of a complicating factor is it? You just alluded to it, but to now not exactly know what the actions that have been taken, and particularly by governments, on whether or not that takes risk out of the worst case scenario situations that I think a lot of people have been worried about recently?
Well, the help by the Fed and regulators helps in trying to slow down a run. That's the case, but it creates a moral hazard. Of course, the banks that failed, the shareholders and the bondholders have lost money, but the fact that the depositors have been made whole implies that other smaller banks can now gamble for redemption and bet on the fact that deposits are de facto insured, even those that are not, to take excessive risk. So at the minimum, regulations on all banks, even some of the smaller ones, have to be tightened in terms of capital and liquidity and so on, because the view was they're small and they're not systemically important. But if one of them goes bust and many other of them go bust, then you have the same thing that happened during the SNL crisis, where you had very small saving and loans association, but hundreds of them went bust, and then it became a systemic banking crisis that led also to a recession. So that's one of the lessons, that even the smaller ones may have a systemic consequence when there is a run on several of them.
Mr. Roubini, I think our audience knows that fear is hard to quantify. It is intangible, but we are watching things play out in real time that can be unsettling, particularly to investors who trust in the system and are looking to not just make money, but actually get ready for things like retirement. What would be your message to investors who are trying to understand this moment and where we might be headed?
Well, if you're an investor, certainly equities in the US and globally are at risk because we're headed towards a hard landing. But the traditional safe asset in a 60-40 or 70-30 portfolio was bonds. When equity prices are higher, bond prices are lower, and vice versa. Risk on, risk off, growth and recession. But what we have learned in the last year is that bonds are not safe, because while there may not be a credit risk for a sovereign like the US, there is a market risk. As the yield go higher, the price falls. And last year, 10-year Treasury lost 20% of the value in price because of the rise in yield. They went down more than the S&P 500, went down only 15%. So what you need to do is to find assets that provide you a hedge against inflation and the basement of fiat currency. Because if average inflation were to be, say, even only 5% over time, 10-year Treasury yields will have to be 7%. Today, they are 3.5%. Last year, they lost 20%. Going from 3.5 to 7 will be another 40% fall in their market value. So retirees or people close to retirement with a lot of fixed income as the defensive asset have to move away from there. They have to go into other stuff like short-term treasuries, inflation index bonds, gold, precious metals, and other assets that may be hedged against the risk of rising inflation and rising bond yields. That's one lesson I don't think has been learned by the banks, because they have all these unrealized losses, has not been learned by endowments, foundation, pension funds, and others. Investors to start learning that that's a meaningful risk. Market risk coming from rising yields, on top of the fact there'll be also credit risk in case we go into a hard landing.
Okay, you've mentioned hard landing a few times in this conversation, and before the collapse of Silicon Valley Bank last week, there was a pretty strongly telegraphed message from the head of the U.S. Federal Reserve, Jay Powell, that the Fed would continue with rate hikes. Obviously, the market has done fresh calculations. There are now some expectations in the markets that by the end of the year, we will see notable rate cuts in this country, Canada. We've already seen the Bank of Canada pause on interest rates, and the market is increasingly anticipating rate cuts by the end of the year. Canada has a lot of exposure to household debt through our mortgage and housing market. Today, we referenced the fact that the ECB pushed ahead with a rate hike, but at what potential cost do any of these central banks risk being more hawkish? Do you think we are nearing or at the end of the rate hike cycle, even if inflation is not tamed, if you're outlining a scenario of a hard landing?
Well, it's possible that central banks may not raise rates further or raise them less than is necessary. In the short run, that might help market sentiment, but it's dangerous because inflation is still way too high. The Fed funds rate should be going towards 6%. The deeper rate in the Eurozone should be going to 4%. If central banks, because they're worried about financial stability, they don't increase interest rates enough, then you'll have a de-anchoring of inflation and inflation expectation. You'll have a wage price spiral, and then down the line, they'll have to hike even more. And then you'll have not only inflation, but you're going to have also inflation and recession, therefore stagflation. So at this point, cutting rates or staying on hold or kicking the can down the road is not going to resolve the problem. And while financial conditions may be easing if they cut rate or stay on hold, credit spreads are widening, and that tightening of financial condition is going to take a toll on financial markets and on the real economy, regardless of what central banks do.